With over 20 plus years of experience in fixed income, currency, and credit markets, Mr. Goenka has held significant roles at various global investment banks such as Deutsche Bank, Merrill Lynch, and RBS across London and Singapore. Today's session actually promises to be very informative as we dive deeper into the topic and our panelists explain what are corporate bonds and learn more about the $2.78 trillion bond market in India. And with that, a warm welcome to you, our panelists, and over to you.
Thank you, Shriram. On behalf of India Bonds and NISM, I would like to welcome you. It's been a humble effort with Professor Shrimal. We've been doing this for over a year now, and we are really pleasantly surprised how many people want to know so much more about corporate bonds. And we really think that education is the way forward, where you take care of your money better by understanding some basic concepts. Two, three rules. Please, Q&A will be at the end. Please keep typing your Q&A in the section. We'll probably speak for about 30 minutes, and the most exciting part is an interactive Q&A. Keep an eye on the chat. We'll ask you questions from time to time. There'll be a participation certificate which will be sent by NISM 2 to 3 working days after you've attended this. We will address that at the end of the conference. But Dr. Shrimal, over to you. Maybe I just run through the table of contents. Today, we'll cover basics of the size of the bond market. As Shriram said, it's a $2.8 trillion market. What are corporate bonds? What are types of corporate bonds? Who issues? Why they issue? How does it benefit your portfolio? And actually, how do you invest in bonds? And what are the key risks? So we'll cover some very basic concepts. So we hope to achieve that after 60 minutes, you know what corporate bonds are, and there is no mystery around them. With that, sir, over to you.
So thank you, Shriram and Vishalji, for this opportunity again. So again, as we discuss about the bond market, so first of all, the basic understanding of the bond is always required. Although this slide that we've been speaking since last so many webinars, but understanding we have a point of view that every time the new attendees will be there, they should be aware about the corporate bonds and what are the bond market. So bond is an instrument which are issued by the company. Company generally issue the instrument to raise a fund from the market. So they are the borrowers. Whenever the bond will issued into the market, the bond is having a face value just like in equity. The bond face value is 10,000 rupees. So minimum issue size of the one investor can invest is 10,000 rupees. When company issue a bond, the company has to pay the interest to the investors. This interest can be the fixed, can be the floating, depending upon the nature of the instrument. But yes, the frequency can be annual, monthly, half yearly, quarterly, depending upon again the nature of instrument, or it can be deep discount or zero coupon bonds also. Once the bonds are issued into the market, compulsory they have to take the rating from the rating agencies. These ratings are considered to be the investment graded and non-investment graded bonds. So again, the Vishalji is going to discuss more about the ratings part, but compulsory ratings is required. And at the time of maturity, the redemption will be done of a bond, and the face value will be returned to the investors. So it is just like taking a loan from the market and giving money back to the market. So this is a basic of the bond that has been issued to the company.
Yeah, just adding, bonds have existed for thousands of years. People give loan, right? It's like giving 10,000 rupees to your friend Akash, and he says, I'll give it back after 1 year with 11,000 rupees, right? So 10,000 is your principal, and 1,000 is the interest. A bond is basically the terms and conditions, which is listed, because an individual can't talk to a company or a government, right? So the security or the instrument which lists all, what interest to pay, when it will come back, that's the bond. Very simple. It's a contract which says that you've given somebody a loan.
So again, the size.
Sir. So I'll probably take this. So a lot of people say, "Arey, bond market samajh mein nahi aata hai. I do not understand." But let me tell you that bond markets in the Western world are bigger than the equity markets. As of 31st March, our bond market size is $2.78 trillion. So it's not a small amount. ऐसा नहीं है कि it's an asset class which is not well known. All of us are bond investors, you know that, because we have money in pension or insurance, and insurance and pension guys are the biggest investors in the bond market. This chart shows you that the corporate bond market is 22.5% of the overall bond market size. Government securities or the government securities totally, and we'll go detail, 67.5%, 77.5%. And just tells you that it's a big size market. Now I'm just breaking down the corporate bond market. It's a 653 lakh thousand crore market. Is corporate market may you divide it, right? So there are companies which are called corporates, which issue 26.5%. The public sector or statutory bodies owned by the government, NBFC or non-banking finance companies issue a lot of bonds. There are housing finance companies and things like that. Just to explain, there's a very, very widespread corporate bond market in the country. Next, please.
Again, the question comes, what corporate bonds are. So corporate bonds are the debt securities which are issued by the corporate or the companies and sold to the investors. It generally represents the loan to the investors. So when we are giving a loan as an investor to the company, and company is going to pay some interest on that loan or debt to us. A specific when the nature of the issue is there, so specific time period is there, it is generally known as the non-convertible debenture. So when we know about the NCDs, so NCDs are the corporate bonds which are issued into the market. So it's a very simple definition: issued by the company or borrowed by the company to the investors. Investors are the lender. The company will pay the interest, and maturity on the maturity, the repayment of the principal amount back to the investor. Very simple
Yeah.
definition is there.
Very interesting nomenclature, sir, here, because people say debenture and bond, what is the difference? NCD and bond, it's all the same. A bond is a promissory note, or basically a bond is the same. The nomenclature or the terminology in India we've used is NCD, non-convertible debentures. So companies issue bonds which are called debentures, and that's why the confusion. There is no confusion. NCD, debenture, bond is the same thing.
Yes. So now coming to the types of corporate bonds. So types of corporate bonds. So since this to the topic is the corporate bonds, so what are the other than the government securities or the state development loans? So types of government bonds are PSU bonds. Any public sector companies issued a bond into the market. State guaranteed bonds are also the state PSU bonds that we can say. The banks issuing a bond into the market, NBFCs, other corporations, municipal bonds are also there. So this all comes under the definition of corporate bonds. And we'll say about the definition of corporate bonds. It means these are the major types where mainly the corporates which are issuing a bond from the market and raising the funds to build the infrastructure, to serve the public, and so on. So these are the various entities that we can say.
So anybody who's not government, government issue government securities, which are also called bonds, state issue bonds, and these are various corporations. Yes, sir. Next one.
Yes. So now why the corporate issue the bonds into the market? The very basic part is to have a business growth. So like equity, so company can have the two options: to raise a fund in the form of equity, or can go with the debts. So for the growth of a business, definitely the company needs some money. So they will raise a fund with the help of the corporate bonds. For refinancing also. So sometimes they want to like finance in the form of the other what we can say, restructuring of the capital structure, that we can say. In that case, the refinancing the company can do, or to raise a working capital finance, especially the commercial papers the corporates are issuing for the short-term borrowings to meet the day-to-day needs. So these are the various what we can say, modes that companies are issuing the corporate bonds into the market. So yes, next please. Again, just like an equity market, there is a primary and secondary market into the corporate bond market. As a part of the investors, most of the persons generally invest in the primary market and hold till maturity. Secondary market exposure is very less, but yes, there is a secondary market exposure into this particular corporate bonds or the fixed income securities. So definition, primaries means the first time when the company is issuing and already listed are traded into the market. It is also known as a new issue and after issue market in the secondary. In the primary market, prices are set. So what are the prices there? Generally, it is issued. Generally, it is issued at a face value. But yes, the price in the secondary market is fluctuating depending on the demand and supply of the instrument. The transaction type. So investors purchase debt security directly from by the issuers. In the secondary market, one investor will buy and sell from the another investors. The frequency of sell securities can also be only be sold at only once in the primary market, but in secondary market multiple times it can be buy and sell. So if I hold, I can sell to you, you hold, you can sell to me, and something like that. the flow of funds. So the issuer directly giving fund to the company, and here the returns from one trading to another investor. So one investor flowing to another trader, the investors. The coupon and yield generally when the primary market is there, it remains same if it is issued at the face value. But in the secondary market, as time passes to the maturity, the yield will varies, but coupon will remain same. So this is the basic primary and secondary market nature of the corporate bonds which are available into the market.
Yeah, I think our audience is well used to it. There are a lot of equity IPOs. So जब IPO आता है, public offering, like bond public offering is primary, and then the stocks or equity trades after that. And similarly for bonds, they're absolutely tradable on the exchange.
Yes. Yes. Over to you, sir.
Yes, sir. Sorry. So private placement and public issue, as we were saying, primary market is where the first time it is issued, not to get confused. Primary market, maybe there's division, there's private placement and there's public issue. Now, public issue bonds are basically targeted to retail and HNIs, 60 to 70%. So let's say company says, I want to raise 300 crores, but 60% or 180 crores I'll only take from retail money, right? So here you can invest from as little as 1,000 to 10,000 rupees. The advantage of a public issue is you don't have to figure out if the price is right or not right. There is a full disclosure. You can buy a 1 year, 2 year, 5 year bond, and there's a fixed coupon, so you don't have to worry. And a lot of people actually invest in the public issue through that. Private placement is nothing when a company says, okay, I want to raise 1,000 crores, but I only want 10 investors. I know they are big investors. Let's say a Tata company. Tata says, I don't want to explain. I don't want to go to public. I know my investors. And then private placement then comes sometimes to be traded into the secondary market. So that's the only difference, private versus public, but both are listed on the exchange. For example, frequent issuers of corporate bonds in private sector, Tata Capital, Mahindra, Muthoot, Piramal, India Bulls, Adani Enterprises has a lot of bonds outstanding which trade. Public sector are typically NHPC, NTPC, National Highways Corporation, Rural Electrification Corporation, which are some examples of issuers who are frequently coming to the market.
Yes, so now coming to what are the benefits of investing into the corporate bonds? Because when we invest, we always think about the benefits. The very first benefit is the relatively stable income. So the corporate bonds generally give the regular income in the form of the coupon. So whatever the coupon or the interest at the time of issue of the instrument, it has been shown, it will pays to you on certain frequency. This frequency is a very stable income is there. So if you want a stable income every month, every half yearly or yearly, depending upon the need of a fund, you should invest into this particular bonds where the stable income is there. As per the portfolio theory says that diversification should be required, because you don't diversify yourself into the market, then you have to bear with a huge losses at some point of time. So proper weightage of the debt and equity should be there in your portfolio, where proper diversification is required, and diversification can be done through the corporate bonds. There are other instruments also, but yes, corporate bond can have the huge weightage and diversification. Then potential of high returns. So some of the corporate bonds are definitely give the high return as compared to saving accounts or the government bonds that we can say. So if you park your money ideally into the saving bank account to have a liquidity where the saving bank account is giving 2.5% it return to you, whereas the corporate bond can give multiply by 3 or 4 depending upon the nature of instrument. It can be do to you, and it is safe also some point of time. Again, the credit quality. So as we discussed in the very first slide also said that there is a risk appetite. You have to decide that what is the credit quality of a bond, whether the triple A rated or double A rated or double A plus or something like that, depending upon nature of instrument. But yes, the low risk is there in as compared to the equity that we can send the liquidity. So, thanks to the regulators and the OBP platforms, where the liquidity is not a major challenge nowadays for the corporate bonds into the market, where you can sell the corporate bond into the secondary market and the liquidity will be provided. So, these are the benefits when you're investing into the corporate bond, and these benefits will help you how to invest into this particular corporate bond. Until unless you're able to understand the benefit, you will not able to invest into the bond market. That benefit is required.
Just adding, sir, when you're saying potential for higher returns, there's a question, how is it different than FD? So FD also pays an interest rate and bonds, corporate bonds pay interest rate. You can earn much higher in corporate bonds than FDs. So one of the benefits is FDs are also important if you have short-term liquidity. You want to park your money for 3 months, 6 months, you should definitely go for fixed deposits. But if you want to earn a regular stable income for a longer time, then corporate bonds give you a much higher return. You have the flexibility to sell anytime in the secondary market, and you can actually diversify your portfolio, right? So FDs are only issued by a few banks and two, three NBFCs. But if you want to buy a company like a public sector, within FD also or within fixed income, you should diversify a portfolio, and hence it helps in diversification benefit.
Yes, definitely.
Let's go next.
Now, what are the returns on the corporate bonds? When you invest into the bond, what are the various types of return you're getting? So number one is a coupon frequency. So you're definitely going to get a coupon. That coupon is fixed generally in nature. If the floating rate coupon is there, the floating rate coupon. But generally on the corporate bond, the nature of the instrument is fixed coupon. Number one. You will have the advantage of the capital gains also. So when you buy a discount and might be possible you hold till maturity, it will mature at par. So that is a capital gain. Or you buy at X price into the secondary market and X plus due to change into the geopolitical risk or interest rate changes or other changes. So there will be advantage of price rise because price and yield is negatively correlated. If the yield will go down, the price will go up and so on. So that will be there. And the reinvestment. So whatever coupon you are receiving from this particular bond market, if you reinvest into the instrument, where slightly more return you are getting. So you just create a cycle where coupon is coming, you invest the coupon into the instrument where slightly more same type of return is there. So a reinvestment can also be given the additional returns to you on the corporate bond. So these are the various sources or the types of return that you will get as compared to the other instruments into the market.
So the biggest question we get asked, difference between coupon and yield to maturity. There is no confusion. Let me simplify for you. When a company issues a bond today, let's say for 5 years, it decides today how much interest is going to pay you for the next 5 years because depending on the current interest rate environment, right? So suppose a company says, okay, today I will issue a bond at 100 rupees a par at 10% for next 5 years. So if you buy a bond and they'll pay you 10 rupees for the next 5 years and give you a principal back. Yield to maturity, the word yield in English dictionary means returns, nothing else. So it means that if you bought a bond today and you held to maturity, which means you don't buy or sell in the middle, then what will be your returns? Now, if you buy a bond, as I gave you an example of 10% at par, your returns will be, your yield to maturity will be 10%. But bond prices move up and down. So if you buy a bond above par, let's say you pay a premium, which means your return or yield will be lower than 10%, very natural and logical. And if you buy a bond below par, then your yield or return will be more than 10%. So bond prices move because of interest rate changes, because of credit changes or the issuer changes. They move on the factors that affect the economy, and you could buy a bond at a discount or at a premium, and your yield or return will change accordingly.
Yes, so now coming to this part that is listed and unlisted. Again, as per the awareness, always the listed should be separate part. Unlisted is there into the market, but regulatory parts, listed comes under the SEBI regulation. Issued and listed under of the NCDs or non-convertible securities Act 2021 and Companies Act 2013, where unlisted only comes under Companies Act 2013. The listed securities is recognized by the stock exchanges like the NSE, BSE. You can trade on the NSE and BSE. Prior mandatory approval is required. But unlisted securities will not listed on the exchange and no approval is required. The listed securities are more liquid. It can be traded through RFQ, over the counter, or exchange through the traded through the exchange. But unlisted are the less liquid and only traded through the OTC, that we can say. If the company listed, if they are not able to pay the interest, delay on the payment of the interest, then 1% penalty is there and 2% additional interest on delay of the security creation. But there is no regulation of the delay or the penalty on the unlisted market. And if yes, if it is listed, the disclosures are required. So proper disclosures, Corporate Governance Act, timely disclosures, who are the where these funds are used and something like that. But there is no applicability of the disclosures on the unlisted market. So always to have better what we can say opportunity, you should invest into the listed securities available into the market.
So I will just reiterate, sir, do
Yes.
not buy unlisted bonds. If anything goes wrong, you have nobody to go to. Unlisted is an agreement between you and a company which is not recognized by any exchange or by SEBI. Sometimes you have practices where on certain platforms people say, "Arey, buy this bond, 15% mil raha hai." Obviously, it's coming at 15 for a risk. If it is unlisted, something were to go wrong, nobody can help you. Not SEBI, not any stockbroker. It is your choice, and we highly advise retail not to buy unlisted and only to buy listed paper.
Yes, now coming to secured and unsecured bond, again, the bonds are of two types which are listed, especially secured and unsecured. So secured bonds are backed by the collateral like the real estate or inventories or other assets the companies have. But unsecured bond doesn't have any collateral. So the repayment depending upon the financial health of a company. Again, the regulation, so secured bond must be registered with the registrar of a company and compliant by the SEBI guidelines. Unless unsecured bond governed by the SEBI, issued and listed, but non-convertible securities act is there. In the secured bond, the risk is lower as compared to the unsecured bond because at the time of default, the investor will have an opportunity of the assets which are as a part of the collateral, but an unsecured, the risk is high because no collateral is there. Interest rates so lower due to the low risk, that we have to understand. If there is low risk, low return as in the form of the interest will be there, but in the unsecured it can be compensatory high return or the high interest rates as compared to the risk part. Recovery of the default, if the company become default or the IBC Act or code that we can say bankruptcy code is there, so the liquidation part will be done, and the based on the valuation, the money will be refunded to the investors. But the recovery depending upon the company remaining after paying all the dates like secured to bank outstanding, all the outstanding the company first pay, and if some money kept, then the opportunity will be given to the unsecured bondholder. The examples like the some of the NBFCs like the Muthoot FinCorp or any other companies where have the underlying assets under as a part of the collateral, it can be considered secured. But sometimes the large company doesn't have the secured bond, so unsecured bond, the Tata Motors without the collaterals are there. So these are the examples of secured and unsecured bonds.
Okay, a lot of questions have come under credit rating. So let me explain to you. Everything has a rating in life, right? You go to a restaurant, it is rated. You go to a movie, you check its ratings, which is, rated from 1 to 5. The best way to think about this is your CIBIL score. Today, if you have a high CIBIL score, then the loan you will get from the bank has a lower rate. If you have a low CIBIL score, you will be charged a high interest rate. Similarly, all companies have ratings. If they have a high credit rating, which means they'll pay you a lower interest rate, which means they are very strong. And if they have a low credit rating, so what we call investment grade has about 10 categories. AAA is the highest, AA plus, AA minus, A plus, right down to triple B minus. Personally, I highly discourage individual investors to buy triple B minus paper. It's not correctly priced, I think, in India sometimes. It should be around 15 to 18%, but people do buy this. It's the riskiest of the investment grade security that you are buying, even though it's listed and everything else. So, please do your due diligence before you buy. And I really think credit specialists, mutual fund specialists, bank and credit funds should, AIF should buy triple B minus. They understand the complicated risk. The good thing is that these ratings are given by some of the agencies as below: CRISIL, ICRA, India Ratings, CARE, Brickwork. All these agencies are regulated by SEBI. So just remember, when you buy a listed bond, it is within the SEBI framework. When there's a credit rating given, it is under the SEBI framework. So you have a lot of places to go to the regulator if something were to go wrong, right? Government securities by India do not have a rating. They're supposed to be beyond any rating or much higher. They're called risk-free. So they do not have government. GSECs don't have a rating, but state development loans or state bonds do have a rating, right? So T-bills and government securities are beyond ratings. But this is the first pulse check when you start your what is my risk appetite, and I'll show you in the next chart, and what is the returns I expect, and how much can I do. Okay, everything there's a risk premium. So bonds also, there is a certain amount, nothing is risk free apart from GSEC, right? So every investment carries a certain risk, and you should understand that risk. This is the first good measure to do a check. Let's go to the next slide, please. This is typically interest rates in the market. So GSECs give you 6.5% to 7%. AAA, AA plus give you 7 to 8%. Some examples are there. AA give you 8 to 9. Single A give you 9 to 11. Triple B give you 11% plus. And non-investment grade is not advised. Triple B minus is really not advised for people to invest in. So this is just a benchmark. You decide what your risk appetite is, what your tenor of the bond investment you want to make, and accordingly choose a bond. Don't please just go with the highest yield. Try and understand the risk involved. Next.
Yes. So now, whenever you invest into market, subject to market risk is there. So when you invest into the bond market, what are the major risk that can be involved? So number one risk is a liquidity risk, as we discussed in the previous slides also. If you invest into the unlisted securities, there can be the liquidity risk. If you invest into low rated securities where below triple B minus, there can be liquidity risk is there. So liquidity risk can be there into the bond market if low rated on unlisted is there. There can be fraud risk also if you like invest to the mediums or modes or the brokers, those who don't provide the listed securities to you, or some frauds can be there, will be, and you will not able to recover your investment amount. So fraud risk is also there. There can be the market risk. This market risk can be considered as the change in the interest rates by the Reserve Bank of India, geopolitical risk, some risk of the war, some risk of the disaster that can be there. So these are the various market risks that can be affect the price of a bond. And if this type of risk will be there, the basic part is there, the yield is going to increase and the price will go up, or reverse can be also there. If the interest rate corrections are there, the price can go down also there. Then the credit risk is there. So if the company become default, or suddenly credit rating agency change their rating from triple A to D, or double B to triple B minus, or something like that, due to this, the this credit risk will be there, and the company will not able to pay the invested amount to you, and company can become a default. So this type of major risk when you invest into the bond market. But this all parts subject to the kind of instrument you are selecting and kind of return you're expecting, because higher the risk, higher the return will always be a challenge in the market. Yes.
Yes, sir. Nothing is risk free. Again, we will
Yes.
say bonds do carry a default risk. We will address that in the Q&A. We have some Q&A regarding that, and we will talk about that. Right.
Yes.
Next slide, please. OBPP. So a lot of people say, how do I start buying a bond? Online bond platforms are SEBI registered, enabled platforms. India Bonds like one of them. You can easily just register KYC. Just always please buy from SEBI regulated platforms. Do not buy. You can easily check on every website. They are supposed to disclose whether they are SEBI registered or not at the bottom. There is, you can Google and ask SEBI registered platforms on SEBI website. There's a full list. My humble request to all investors, do not buy from unregulated platforms. Again, you have no recourse to any regulator if something were to go wrong. How to buy corporate bonds is very, very simple. You can just go online, you do a quick digital KYC in 3 to 4 minutes. You choose the bond and you make a payment. On the next slide, we'll cover the basics. Your payment is safe and secure. All on bond online bond platforms, your money goes directly to the National Clearing Exchange. Even unlike equity, where you pay to your broker account, you don't. It goes directly to the clearing exchange, who will directly transfer the bond to your demat account linked with KYC. You can start exploring and start looking straight on an online bond platform, but just very, very simple. There are apps out there. You can download the app and you can discover. Next slide, please. busting some myths on the bond market. These are basic questions, sir. You and I face every webinar. So इस बार हमने list बना ली उसकी. Corporate bonds have no lock-in period and are tradable, unlike FDs or other instruments like RBI savings or NPS account. You do need a demat account to start investing. On a platform like ours, you can use any demat account. You don't have to open a demat account with us and attach it to your KYC. Payments go directly to the National Clearing House, who transfer bonds directly to your demat account. Again, no money touches any platform. All interest payments and redemptions, all the money that you earn is paid directly into your bank account by the company. So it's like, suppose you buy an equity, the dividend comes from the company, it goes directly to your bank account, which is attached to your KYC account. So even in a bond, all interest payments and redemptions go directly to your bank account, which is linked to your KYC by the company. People ask about tax. All interest income has a 10% TDS and it's taxed at your slab rate. Any capital gains you make. So, for example, if you bought a government security last year at 7% at 100, it went to 105. So, that 5 rupees capital gain after 12 months is charged as long term capital gains if you were to sell that bond in the middle. On most platforms, as I said, KYC is digital, and most platforms there's zero account opening or charges of brokerage, or there's no brokerage charges. That is mostly on all the other, most of the bond platforms that we find. Next, please. All right. With that, we come to the end of the presentation, and now we will open to Q&A. Sir, there are a lot of questions. Let's start talking one by one. We'll address as many questions as possible. Again, the question is on government bond rating, sir. So do you want to talk about there is ratings on government bond, and I can talk about international rating.
Yes, so government bond ratings generally in the government bonds they doesn't have the rating. They are the so-called as souvenir bonds. So souvenir bond is something which have a zero default risk has to be considered, a low risk as compared to the part. Whereas the corporate bonds come under the regulation of SEBI. So any bonds come under regulation of SEBI, they compulsory has to take the rating from the rating agency. Minimum one should be required.
There was a recent news that India got upgraded by S&P on the credit rating from triple B minus to triple B, which is very good for our country. International rating agencies also have a similar thing, and India was at triple B minus for last 18 years. What will happen? Happen means India has a better credit globally, which means we should see in the longer term more asset allocation and more foreign investments into the country, as it's considered as a better risk. So, relationship between interest rate and bond prices.
So, as I discussed in my slide also, so whenever the interest rate will go up, the price of the bond will go down, and whenever the interest rate will go up, the price of the bond go, sorry, down, the price of the bond will go up. So, inverse related. So, if there is a negative relationship between price and the interest rate, so that is simple change. If RBI is going to change the interest rate, it definitely going to affect the any bond which are listed into the market.
Yeah. One question is, where should I look in the bond documentation for important information? If you look at a bond documentation, there's a summary which is terms of issue or a KID. There are financials which are there, but importantly, you have to look at covenants. You know, what are the health ratios, which is the debt equity ratio. There are 4 or 5 important debt ratios to look at, and you should understand, and everyone should do the due diligence and learn more about the company and the industry. Somebody mentioned about RBI, that GSEC and T-bills and SDL can be bought on RBI retail. You are absolutely right. Amazing effort by the government and RBI. You can log on. The only simple difference is that when you buy on RBI, it's like a SGL. It's a ledger recording that you own the government security within RBI. But if you buy from a stockbroker or online bond platform, then it comes into your demat account, right? So you have all your equities and financial securities in demat, and it is helpful. Lot of questions around default. So maybe, sir, I'll take this.
Yes.
I've lived through those times. So people said, yes, bonds have defaulted in the past in the country. In 2019-20, people named DHFL, etc. All I'm saying is people forget that Nifty was also at 5,000. So since 2016, there's a Indian bankruptcy code which came, which says that if there's a default, they've created a tribunal called NCLT, where you can, all the bondholders get together, and outside the judicial regular court system, it's a fast track process of recovering your money. By fast track, I still mean it takes 1, 2, 3 years sometimes. And there is a professional appointed to do this. The auditors appointed to do that. Uh, but since IBC came, a lot of cleansing has happened. What do I mean by that? A lot more rules and regulations have come, lot more transparency has come. Uh, a slide we missed was about debenture trustee. Debenture trustee is also SEBI regulated. Every bond has a trustee, which if something were to go wrong in the covenant, because as a common man, I can't understand a 100-page document, they will email the bondholders, ki this covenant got breached or this credit rating happened. They will keep you up with all that happens with the company. So the infrastructure and the regulation around bond investments has really improved. No one really complains about why Nifty was 5,000 or a stock falls around 50, 60%. And typical returns in equity is 12 to 15, and bonds you can make 8 to 12%. So we've really developed as a country. We were hardly a $1 trillion economy 5, 6 years ago. We are a $4 trillion economy. So we've got to just think that there's better infrastructure, better digital infrastructure and information to make better decisions right now. Uh, Sir, center versus state, which is higher risk or lower risk, and why?
So again, center versus state, definitely the center is the low risk because the yield or the coupon that bond is providing is compared to the less to the state. That is simple part, but both are the souvenir bonds, so default chances will be less. But yes, more the spread to the benchmark, higher the risk that you can cover.
Yeah, so central government is supposed to be the strongest, and each state has slightly different economy. So central government trades at the lowest yield, and state development loans at a higher. There's also another category called state guaranteed bonds. They are corporate bonds. They're not government securities. They can even yield you up as high as 8.5, 9%. They are, utility firms owned by state governments. They have a guarantee, but they're not issued by state government, so they have a little higher risk on that. Okay, now senior, which section? Da, 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 let me run the questions. Corporate bonds can be bought from the demat account. What is the role of India? India Bonds is just an online bond platform which facilitates buying, gives you choices to click and buy. That's all. It's like you can't buy equity unless you go through a stockbroker or an associated person who has the license. Similarly, bond platform is a licensed platform to help you buy bonds. Are corporate bonds considered a safe investment? Do they involve higher risk? Sir, do you want to take that?
No, sir, you can take this much.
Yes, everything in life has a risk. There's nothing guaranteed. Even your FDs are guaranteed only by 5 lakh rupees by DIGC. Only government bonds in India issued by INR bonds or INR bonds are considered to be risk free. Anything else, corporate bonds also carry risk. The risk levels are determined by the ratings AAA, AA, single B. It depends on what is your risk appetite. All we are simply saying is people usually have very high equity exposure, but 20 to 30% of a portfolio should be in fixed income. Sir, why is corporate bond not developed in India? Very easy. Corporate bond is a very large market only by institutions. There was no access early thanks to SEBI regulation, digitalization, technology. Now we're providing this access to the entire investor class. People are so used to digital, to do your mutual funds and equity investments, digital interactions. Corporate bonds financial infrastructure in the country was not developed. What do I mean by that? Payments kaise hona hai? How will bonds settle was not all clear for individuals, was for institutions. Now that is developed, fastly developing, and that's why it's coming easy. Yeah, are corporate bonds liquid as compared to equity market? No, sir. Equity market is the most liquid, but in equity also you have large cap. If you have a small cap and mid cap, liquidity sometimes you miss. So the rule for corporate bonds is AAA, AA have very a lot of liquidity. When you go to single A, triple B, yes, there are liquid. Sometimes it takes time to find a buyer, and that's why you get a higher return for the risk that you're taking for illiquidity. So yes, they are liquid, but liquidity drops off as the ratings drop, much like equity, large cap, mid cap, small cap. What is the role of someone like Catalyst, sir? Catalyst is a debenture trustee I just spoke. Its duty is to respond and email you on the companies that you have invested in because you are a holder on record and inform you on their health. Do corporate bonds come under debt mutual funds? Debt mutual funds actually invest in corporate bonds. The benefit of debt mutual funds is, sir, you have immediate liquidity on NAV. But there are other issues. The cost if debt mutual funds are higher, and if you construct your own debt direct bond portfolio, you could earn higher interest rate, and you're not dependent on somebody else. How to sell bonds in the secondary market? It's very simple. You go to a stockbroker or a platform like ours. You send a request for quote. We find you a buyer, and that's how you sell it. We cannot forward you this presentation. A lot of questions. This is proprietary. But we are happy. A recording of this will be available on YouTube channels of NISM and India Bonds, and later you can go and view that. What are government bonds? We've understood. We've spoken about taxation, sir. Which bonds are better to invest, sir? We cannot tell you. We are not here to recommend. If you want to start your journey, start with the safe government security AAA, AA. You can even start from as low as 10,000. Wait 2-3 months, understand how it works, and then maybe you buy a higher rating or high yielding bond. Can NRI invest? Yes, NRI can invest. The KYC is done offline. You can write to us or something, and if you have a NRO account and a DMAT account existing, then you can invest. People are saying, isn't it better to own the demat account with stockbroker? It's easy to sell. I agree with you. India Bonds does not ask you to open a demat account. We've kept the flexibility open to others. There's a DI slip which you have to fill the form. We are working with clearing agencies to take away that old school process of filling DI forms, DI slips, and make it digital also. I think in 2 to 3 months, the regulators will come with some progressive news on that. Can private company invest? Yes, companies can also, and HUFs can also register and KYC and buy bonds. Corporate bond used for margin FNO. Sir, you want to answer? You want me to take it? We are a FNO crazy country. Even though SEBI says 91% people lose money, I'm sure I'm talking to the remaining 9%. No, sir, corporate bonds usually are not used for FNO. Government securities are usually used for FNO. Margin from other stockbrokers. That's what we understand. Is it good to invest in bond case, which is a portfolio? So it's always good to diversify. Firstly, your portfolio should be diversified across asset classes, right? Equity, gold, fixed income. Within fixed income, if you can buy, you never just buy one stock. You buy 5, 6, 7 stocks. So similarly, if you buy a bond case and diversify a portfolio, sir will tell you diversification is always better for a long-term portfolio investment. So, difference between senior, secured, unsecured, and subordinated bond, if you can take this.
Yeah, so as we discussed, like the senior secured bonds are the bonds which the first priority at the time of default will be there. So they are much more secure than the seniority will be given at the time of the default of a company. Secured bond, as we discussed, that it has a collateral, and subordinated debts are issued generally by the banks and NBFCs. So that doesn't have the secure, what we can say, any collateral behind that. There are only subordinate securities which are issued by the banks.
Yes, subordinated means if something were to happen, then senior will get money or later in the line, like a second lien, right? Again, a question on default. Will the recovery amount come automatically to me, sir? What happens default? Ke baad there's a full process where bondholders, the debenture trustee gets in touch with you. You have to sign, you have to agree to things. And then, yeah, if there is a recovery, which usually there is, mostly your money will come back to your account. When do we have muni bonds issued by municipal corporations? Very good question. Municipal bonds have started being issued. I think Indore Municipal has issued. Recently, there was a Agra Municipal Corporation bond which is issued. So there are not as many, but there are municipal.
17 of now.
17, huh?
17.
A question, how can wealth and mutual fund distributors position unlisted bonds? Sir, no comment. Do not buy unlisted bonds. It is for HNIs or AIFs, then you can. But enlisted bonds should be giving you 15 to 18% before even you start to invest, and you should understand what the risk is. There's a question on AT1 bonds. What is AT1? Tier 1 bonds by banks, sir. Do you want to take that?
So AT1 bonds are the perpetual bonds. Generally, they are issued by the banks mainly, and it has the nature of the call before any time if the banks fill. So that they are generally issued by the banks. AT1 bonds. That is perpetuality in nature.
Yeah. Someone is correcting us that Pune Municipal Corporation has also issued. I'm sure
Yeah.
somebody's logged in Pune.
So 17, as I told you,
17.
total 17 are there as of now.
So that is a very good question. Again, is there a lock-in period? There is no lock-in period in bonds. You can buy today, sell it in 2, 3 days time. For capital gain calculation, you have to take the principal amount, not plus accrued. So because remember, interest is charged at your slab rate, principal to principal where you sell, is that difference is calculated for capital gains. Can bonds can be bought in primary and secondary? Yes, absolutely. You can buy bonds in primary or secondary. A question on monthly income? Yes. For example, if you go on India bonds, there's a tab called monthly income because all of us have monthly EMIs. You can buy bonds which give you a monthly coupon to offset your EMIs also, right? And depending, let's say you want 10,000 rupees monthly income or 1.2 lakhs, then you'll have to invest for a 10% bond, 12 lakhs into that to generate that income. So basically, yes. And all these websites, all the platforms give you a cash flow. We actually have a good thing called portfolio dashboard, which gives you cash flow across all your bonds. Sovereign gold bond and corporate bond difference, sir?
Yes, so SGBs are so basically the bonds which are issued by the Reserve Bank of India. That is based the gold bond only that we can say SGB sovereign gold bonds, which is the nature of providing the coupon of 2.5, but the primary market issue is not available of the SGB right now in
That
India.
is,
RBI stop issuing the SGB. And the corporate bonds, the second is a corporate bond. So corporate bonds are issued by the any private or the public listed companies. So any of this, as we shown, either PSU or state company or the any private companies can issue the corporate bond into the market. But again, the nature, these SGB can be considered as souvenir, but corporate is subject to the risk is available into the market.
yeah, sovereign gold bonds have stopped because gold rallied so much that it became actually non-productive for the government to issue SGBs. People who invested made a lot of money. If you hold till maturity, your gains are tax-free. It's very different than corporate. Sovereign, as sir explained, is sovereign means the country, right? The central government. How can bonds be bought in primary and secondary, sir? As explained, go to an online bond platform like India Bonds. The primary bonds, secondary bonds can be bought and sold. Bonds are also callable and puttable. Can you explain, please, sir, to you?
Yes, so definitely the bonds are callable. So in the putable nature bonds in India, I think it is not available to put to liquidate. Again, the OBPPs are created by the SEBI where you can put before the maturity. But yes, callable, the company has a right if the callable bonds are issued at the time of the life of the bond, any time before the maturity, company can call from the market. It can be the partial call or it can be the full call depending upon the nature.
Yeah. Callable means the company has an option to repay you earlier. The company can call the bond. If it's a 5-year bond with a 3-year call, they can say, we are doing very well. We can raise cheaper debt. They call back. There are also puttable bonds, sir, where the investor has the right to put the bonds.
Investor has a right to put.
Yeah, which means investor has the right to redeem the bond earlier than maturity. We are getting asked some very smart questions now. Technical guys are coming in. Can I short bonds? No, sir. In India, you cannot short bonds, corporate or government bonds. It is not allowed. Institutions for hedging purposes can only do through interest rate swaps, but will not. That's not purview of today's discussion. But you cannot short bonds in India. Yeah. Okay. We are doing very well for time. We have time for next 3-4 minutes to take. Okay. What is a coupon? What is a repo rate, sir? Do you want to take this? Yeah.
So repo rates are the rates which are the policies of the government of India, the monetary policy where the Reserve Bank of India introduced the repo rates into the market. Every quarter, depending upon the demand and supply or depending on policy of the government announce the repo rate. Either it can be changed or it can be kept as the same. And when it's about the policies, so again, depending upon the demand and supply of the currency or the money, through control that, RBI generally introduced the repo rate into the market. So
Yeah, so
every
repo rate is the benchmark rate of the country, which RBI says where banks, interest rate that banks buy and sell money a little bit. That becomes the basis for everything else. Government securities will give you higher than repo rate. AAA will give you higher than government securities. AA will give you higher than AAA, and that's how it moves. Uh, Question, yeah, this is very interesting. We forgot. If my interest in the year is 10,000, less than 10,000, I am not under tax bracket. Will TDS be deducted? Very good question. So there's something called 15G and 15F forms that can be filled. 15G, if you do not fall under, if you're tax, you're not taxable, you can fill that form. That form is actually available on India Bonds website. There's a separate page we've created, 15G, 15H. You fill the form and submit to the issuer. And even the email of the issuer is available on our website, and say, I'm not taxable. Please do not deduct TDS. Similarly, if you're a senior citizen, there's a 15F form, and you say, okay, please do not deduct my TDS and submit the form. It's an automated process on India Bonds. You can download the form, it's very easy, and you can submit. But 15G and F are very important for senior investors or senior citizens, and also for people in the lower tax bracket. Can we gift or transfer bonds to one another? Sir, we are not tax experts. Yes, you can transfer bonds from one demat to another under your family account, I think. I'm not very sure. Sir, do you have any idea on this gifting
So
part?
the gifting is there, but yes, any securities which you hold, you can gift to your family members.
Yes.
So if you have the demat account, you have to give the requisition to these RTS basically. So through RTA, you can nominate to whom demat account you want to transfer as a part of the gift of the securities. Any security, listed security, you can transfer.
There is a question, what is last traded yield? Sir, last traded yield means at what yield the security traded before the markets closed, right? So bond markets typically close around 4:30 uh, till 3:30. You can do a T plus zero. You can actually pay for a bond at 3 o'clock and have it in your demat at 5 o'clock. So on India Bonds platform, you can get a T0. T plus 1 means you pay today and the bond settles tomorrow. After 4:30, there's a feature called AMO, after market hours. Because bond investment, unlike equity, you don't need to track the market every minute. You can decide at your leisure on Saturday, Sunday, and place an AMO order. So when you place an AMO order, there'll be like, this is the last traded yield. Monday morning or next trading day when it opens, the next trading day, hopefully you'll get that yield if nothing changes. So that's what last traded yield is. There's a feedback. Your webinar timing is odd for office goers. I think NISM and India Bonds team, please note, sir, we've usually tried to do 4 to 5 p.m. because it's after equity market hours.
Yes, yes.
We've not experimented with Saturday because at all. And if we do much later than 6 p.m., then people are on the way. So I don't know. But the feedback is taken. Maybe you can type in what is the preferred timing, and we will ask NISM and India Bonds team. Uh, a good question. Does the yield keep changing on frequent basis? No, actually, it does not. On government securities, it changes because it's very, very liquid. To give you an idea, 50,000 crores secondary market volume daily happens in government securities. In corporate bonds, yield does not change in daily basis, mostly, unless there's a big event, but they could change over 3, 4 days or a week or 2 weeks or something like that. I think that brings us to the end of all the questions. Uh, Again, I would love to, I think Shriram, over to you, but we'd love to thank, uh, would love to get feedback from the audience if they enjoyed, what more we can do. But Shriram, over to you before we close. Yeah.
Absolutely, absolutely. I would say it's been a great session on corporate bonds and saw some very curious questions. A big thanks to Dr. Kapil and Vishal for your time. To our amazing audience, make sure you follow India Bonds and NISM channels to stay informed on upcoming webinars and more such educational sessions. And if anything else comes to your minds, feel free to write to us. We'll get back to you as soon as possible. And signing off for today. Thank you so much.
So thank you, Vishalji. Thank you, Shriram.
Thank you, sir.
We'll meet
Yeah,
soon.
thank you. Yeah. Thank you, NSM team. Kapilji, always a pleasure to do this session. Thank you to the audience for showing up. It's an effort to educate people. I hope you find the session informational. Please give us any feedback, anything you like to see improve. This is a monthly webinar. We try to do different basic topics, but very happy to answer all your questions. Thank you once again, and happy investing.
Yeah. Thank you.
Thank you.